I'd like to thank you for joining me today. The lead topic I'm going to talk about today is something you may not know about markets and elections. Once I'm done with the presentation, I'm open to taking questions on the topic that I'm going over, as well as any other things that you might want to ask about. So first, some common election-related questions. Whenever elections come, there's always a lot of who's going to win, how do we position our portfolio for the outcome, what stocks will do best, and is this really the most important election year ever? Because you often hear rhetoric like that. One thing that this is not going to be is a discussion about the merits of either political candidate. At the same time, much is made of the election's potential outcome and its impact on the market, and that's really what I want to address here. The effect of the election results can weigh on our country's future heavily, and especially on everyone's minds. The stakes have rarely felt higher than they do this year. Debates rage across Twitter among strangers and Facebook among family and friends. To what degree do you let your politics impact your relationships or your financial decisions? Should you adjust your retirement date because of the election or what its effect might be on the market? Should you rearrange your investment portfolio? Do you do these things based on what you think will happen or just to be cautious? There's a lot of things for investors to be worried about as we approach this election. The number one concern is probably the election, but it's closely followed by COVID-19 and its effect on our economy and our lives. The mass unemployment that we face. Right now, there's a lot of debate about government stimulus. We've heard we might have more, we might not. There's been no agreement to have any additional stimulus. And we've certainly had a lot of fluctuation in the stock market this year. We've seen the market go down over 30% from February to March, and it's up after that strongly. As a matter of fact, we recovered all those losses and we've set new highs. But politics, economics, and financial markets don't necessarily go together. If you're thinking about the financial market, what really should matter is earnings and cash flow growth. Those are more important to the financial markets than politics and economics, to be honest. Do election results and the results really matter to investors? Well, here we can see this slide shows the annualized return during presidential terms. All the red bars are for the Republican presidents. The blue bars are for Democratic presidents. The worst one at the bottom was Hoover, and that was the Great Depression. The best one here was FDR. How you act and manage your portfolio depends on your investment objectives and timeframes. Do you use the political calendar to set your goals or something more personal, like your desired retirement date and future cash flow needs? Before your answer, think about the following. Think back to November of 2016. The futures market plunged when Trump emerged victorious. Now we're close to record highs once again. When Obama was elected, predictions were even more hysterical. What happened? Market returns were among the best ever during Obama's tenure. And before that, Democrats declared a state of financial emergency when George W. Bush emerged victorious after a disputed election. In short, don't believe the hype. Stay focused on your long-term goals. Being able to predict the market is a fool's errand. We can't really do that. I like to tell the story sometimes. I was an energy analyst. I covered oil and gas stocks for 7 years. And one of the things I had to do was forecast oil and natural gas prices. So I used to get calls from reporters, or I was on TV, newspaper reporters, all kinds of media. And they'd say, Phil, so what do you think the price of oil is going to be? And I'd say, well, here's the thing. Part of my job, I'm supposed to predict the price of oil. So I'm going to give you a number. But there's one thing that I'm almost certain of. There's one number it's not going to be, and that's the number that I'm about to tell you. And I did that for 7 years. So that was 28 quarters. One quarter, I hit it on the nose. And that was just luck. So what we must get right, to know what's going to happen, we have to know who wins the election. Then we have to know how stocks react. Then we have to know which stocks are the winners and the losers. First of all, those are hard questions to answer. Second of all, they're all short-term questions. The stock market's not a three-month investment. When you put money in the market, you should expect to keep it there for 5 years or more. Let's look more at history. If we look at this chart, it tells you the president's party, does it really matter to the market? Probably not. You can see that stocks have continued higher regardless of the president's party. almost every one of these, if you look at blue or red, the market was higher at the end of the term than it was at the beginning. The first 3 years, order of the nominal performance from this shows the first 3 years of every president's term going back for the last 10 presidents, and it doesn't include Kennedy and Ford because they didn't serve full terms. And you can see the best return was under Clinton for the first 3 years, followed by Dwight Eisenhower, then Obama, then Trump, then George W. Bush. So there's a mixture of Democrats and Republicans. On the bottom, you have Carter and Nixon, a Democrat and a Republican. As Warren Buffett said, if you mix politics and investing, you're making a big mistake. So don't worry so much about what's happening with the election. And I think that's probably the biggest takeaway. There's others, but that's definitely one of the biggest takeaways. We can take a look, going a little bit further back. The median market move here, as this shows, this goes all the way back to, goes back many years, this chart. And it tells you that the median market move is a little bit larger for Democratic presidents. The annualized return is the same. The best returns were Coolidge, and that was leading into the Great Depression. And Clinton, that was leading into the internet bubble. The worst returns were Hoover, that was the Great Depression. And then Nixon, and that was when we had the oil crisis. We had a president that likely would have been impeached if he didn't resign. We went off the gold standard. There were a lot of things going on, and it actually was when we started the gateway to the high inflation that we had going through all through the 70s. One of the things that really is good for the market is a split Congress. You look here, you can see that the performance of divided governments in the US stock market in the bottom chart. You can see that when we have a split market, that a split Congress, that's actually a divided government, that's actually when the market does best. Without congressional support, there really isn't much a president can do. And the makeup of Congress appears to matter much more than the president's party. Other things that matter are what kind of market is inherited. And the president versus the era in which he holds office. Like I said, the worst returns were for Coolidge because of and Hoover because of the Great Depression. I'm sorry, Coolidge was good. It was going into the Depression. Hoover it was bad during Hoover because that was the Great Depression. And Clinton, we had a bubble. And so he happened to serve during the time we had a really good era for the market. If we look here, a standard retire kind of portfolio that people could put together is a 60-40 portfolio. And if you look at the market return in election years versus non-election years, we look at that 60-40 portfolio, which is 60% stocks and 40% bonds. It shows no significant statistical difference in returns. And this is going back all the way to the 1870s. You can see that the average return during election years was 8.9%. That's 40 periods. The average return during non-election years was 8.1%. That's 120 different periods. What determines the market movements isn't so much which party is in power, but rather events. And just to give you some context for this year, as of today, the S&P 500 is up 6.7% year to date. It's up 2.5% in the first 8 days of the fourth quarter. If we look at bonds and I use an ETF representing the Lehman Ag, that's up 4.7% year to date. And the Lehman Ag is a broad-based bond index. And it's down 0.3% year to date. So if I was to try to look at a 60-40 portfolio, that would mean it'd be up about 6% so far this year and about 1.4% for the quarter. Now, does the year in the president's term matter? That matters a little bit more. We can see here that for all years, the market's up. This is going back to 1926. The market's up 10.1% for all years. During presidential election years, the market's up 11.3% on average. From the midterm election year, that's the worst year in the cycle. It's up 8.6%. And non-election years, that would be the odd years, the first and third year of the cycle, that's when the market actually does best. I guess we have more optimism about what the future might hold. But all in all, presidents really have little to do with it. The market's driven, as I said earlier, the market's driven by company earnings and cash flows. Now, I've said all this, and so here's some sectors to consider in the market, no matter who wins. Telemedicine. Growth is accelerated in telemedicine because of the coronavirus. Surveys report that 75% of people are comfortable with telemedicine. Piping in America, that's broadband, faster speeds for internet, going to more rural areas. We need to get faster for the internet, and because the number of people streaming content, the number of users, and the way we do business, all of those have increased. Clean energy, green energy, electric car usage continues to grow, artificial intelligence through autonomous driving also seems likely. And I know that there's a difference politically on the views on clean energy, but it appears as if that's going to continue to evolve regardless of one's personal views on climate change. And then automation in terms of artificial intelligence, virtual reality, the connect to house. I mean, all those things are growing, but you have to be careful. Those might be sectors to consider, but you also have to look at the valuations of the stocks, because sometimes people get too excited about the latest trends and you don't really find good opportunities there. Investors, the best thing you can do if you're an investor, stay invested. That's likely going to be the best approach. The best performing portfolio over the past 120 years was one that stayed fully invested through both Democratic and Republican administrations. Partisan portfolios, which would invest only when a Democrat or a Republican was in office, underperformed by millions of dollars. And if you look at the chart, you can see those two the red and blue line way down at the bottom. Those underperformed by millions of dollars, the bipartisan portfolio that stayed investors regardless of who was in power. The difference is a result in part of the fact that the US stock market rose consistently over the past 120 years. Yes, there's been bad years, but overall the direction has been up. You know, that 120-year period, we've had 2 world wars, we've had 2 major financial crises, the Great Depression and the global financial crisis of 2008, 2009. We may be going through another one now. It's a little bit early to say where this is going to rank compared to that. I mean, I know that the unemployment numbers are worse, and we don't know how many businesses are going to come back. But certainly through all this time, the market has endured. The more time investors spent participating in markets, that means being invested, the better they've done financially. So what should investors do? Understand your portfolio and what you want it to provide. What portion of your investment portfolio do you need to consume for retirement and when? In other words, what's your investment objective? Is your portfolio structured to help you meet it? Are you comfortable that your portfolio can deliver a secure cash flow during retirement no matter what happens both now and in the future? Do you have a retirement income plan? That can help you identify your future spending, the sources of your cash flows, and your risks. Can your portfolio provide your retirement paycheck? Because remember, when we stop working, we're not getting a regular paycheck. So our portfolio is really our paycheck. And so that's the dividends and the interest that it pays. That can be considered a retirement paycheck. Once you have a plan, the only reason to change your portfolio's asset allocation is your financial situation or your long-term goals have changed. For most, the upcoming election won't trigger personal financial changes, warranting portfolio adjustments. So if you're looking to change your portfolio now, make sure the changes are for the right reasons and not the wrong ones. So that's the end of that formal part of the presentation. I did have one question from somebody that wasn't able to make it today. I'm going to answer it because I've recorded the session so I can share it with him later. But he was asking about the idea that traders move into a cash position. He says their cash position isn't actually cash. It's transferred into a long-term treasury ETF or just directly into treasuries. And he says, what confuses me, if that treasury ETF is down 32 cents, how's that better than putting it into an interest-bearing account? So I don't have a great answer to the question, to be honest, but I do know that retail investors, they can sell out on the market when prices are high and they can wait for a better buying price and they can be in cash. Institutional investors often have mandates and other rules and regulations that make them unable to do that because of those regulations and the investor pressure. So they can't just go out of the market and they can't just sit with cash on the sidelines. And therefore, they would have to hold treasuries or some other security instead. So if anybody has any questions, please go ahead. If you're unable to unmute yourself to ask a question, just raise your hand and I'll be sure to unmute you so that you can ask.
Bill.
Rich?
I was just curious. You talked about tracking oil stocks, energy for so many years. I was curious what you think about the whole energy thing. Like right now, ExxonMobil is their dividend is sky high and they're at a really low price. What do you think about that?
So if you look at Exxon, the energy industry in general, it's really capital intensive. It costs a lot of money to drill for oil and natural gas. If you look at Exxon over the last decade or more, it spent a lot of money trying to find new sources of oil and developing new sources of oil and natural gas. And its production is flat to down. So that's not really a good outcome. And if I look at Exxon, like personally, I don't invest in Exxon because it's not free cash flow positive. The amount of debt that it has is growing. Yeah, I think that there were a lot of companies that took a bath because of and the implications of the falling prices. And you remember that Exxon, I believe it was in 2009, they bought XTO, and XTO is one of the early frackers. And that business is not, fracking wells don't perform the same as conventional wells. Because all oil and gas has a decline curve. The production goes up and it peaks and then it falls. And the fracking, that business is not a good business. And so, that's generally been something that I stay away from. And to me, the reason that the price is where it is and the dividend yield is where it is that it seems to me that it's likely that there's a dividend cut. So you always have to watch when the yield on a stock grows too much. Oftentimes that means the market expects them to cut the dividend. And so that could certainly be what's happened with Exxon. I mentioned earlier about clean energy, green energy. I mean, I think that we are moving in that direction. It's not going to happen that fast. I mean, it takes 15 to 20 years at least to turn over an auto fleet. So it's not like that's going to happen immediately, but I am leery of a lot of the conventional oil companies and the large majors that have really provided investors with a lot of returns over time, but more recently they've struggled.
I don't know if you can see me.
Any other questions? All right, well, if there aren't any other questions, if anybody would like to schedule an appointment to talk, the link to my calendar shows here. And if you're not on my mailing list, you're welcome to sign up. Here's the way that you can do that. And I want to thank you again for attending, and I'll be back again in 2 weeks with another Ask Me Anything program. Thank you and have a good night.